Welcome to Global North. Please subscribe to the channel and press the bell icon for more updates. I bet you didn't know just how deep the economic rivalry between China and India has become. On November 25, 2025, Beijing stunned the business world by banning all new Chinese investment in India's booming auto industry. This is more than a policy tweak. It's a bold economic move that deepens the rift between Asia's two giants. The ban slams the brakes on Chinese money flowing into Indian car factories, dealerships, and tech partnerships. It's a direct response to India's push to become a global manufacturing hub, especially in autos. Chinese firms can no longer build new plants, form joint ventures, or buy stakes in Indian auto companies. The timing is crucial. India's Make in India campaign is gaining momentum, and this ban is a calculated attempt to slow it down. The move forces India to seek new sources of capital and technology, disrupting plans across the sector. From factory floors in Pune to showrooms in Delhi, the shockwaves are immediate. This is not just about economics, it's a strategic escalation, moving the rivalry from the border to the heart of India's industrial ambitions. The world is watching as the fallout begins. To grasp the impact, consider the scale. China is the world's auto superpower, leading in both production and sales, and setting global trends, especially in electric vehicles. India is the world's third largest auto market, growing fast with a young car-hungry population. For global automakers, India is the next big prize, a massive market and a low-cost export base. The two countries have been both rivals and partners, with Chinese firms eager to expand in India and Indian companies learning from China's rapid industrialization. Their auto sectors are deeply intertwined, sharing suppliers, technology, and ambitions. China's dominance in EV batteries and supply chains was a key advantage for Indian automakers hoping to leapfrog into electric mobility. Now that path is blocked. The ban severs a vital link, forcing India to either build its own capabilities or find new, likely costlier partners. This is a major realignment in the global auto industry. The decoupling of these two giants will reshape supply chains, investment flows, and the future of electric vehicles. The stakes are enormous, not just for India and China, but for the entire global auto ecosystem. The world's gears are grinding in a new direction. What does this ban look like on the ground? Imagine a Chinese automaker planning a billion-dollar factory in India. Now, that project is dead. Thousands of jobs, new technology, and local supplier deals vanish overnight. Existing Chinese brands in India, like MG Motor, can't expand or invest in new facilities. Indian companies lose access to Chinese tech and capital, stalling joint ventures and innovation. The ban also blocks smaller Chinese suppliers from setting up shop in India, keeping costs high and supply chains fragile. Indian automakers must now rely on more expensive local financing or hunt for new international partners. The ripple effect is huge: cancelled projects, lost jobs, and delayed product launches. The flow of knowledge and technology is disrupted, slowing India's progress in EVs and advanced manufacturing. The ban isn't just about money, it's about cutting off the lifeblood of growth and innovation. Every blocked investment triggers a chain reaction, making India's auto ambitions harder to achieve. The industry faces a new era of uncertainty. For Indian car makers, the ban creates winners and losers. Domestic giants like Tata Motors and Mahindra may benefit, as Chinese rivals are now unable to expand, giving local brands a chance to dominate, especially in EVs. But for others, the loss of Chinese partnerships means scrambling for new tech and supply deals, often at higher costs and with delays. Foreign automakers in India, like Hyundai and Maruti Suzuki, face new risks as their supply chains, often reliant on Chinese components, become more vulnerable. The ban accelerates India's push for self-reliance, with the government likely to ramp up incentives for local manufacturing of batteries, semiconductors, and EV parts. This transition will be costly and disruptive in the short term, but could make India's auto sector more resilient in the long run. The industry must adapt quickly or risk falling behind. The race for self-sufficiency is on. The real impact hits workers and consumers. Cancelled factories mean thousands of lost jobs, not just on assembly lines but in construction, logistics, and engineering. For India's young workforce, this is a major setback. Car buyers will also feel the pinch. Less competition means higher prices and fewer choices, especially for affordable tech-packed vehicles. The dream of cheap electric cars is pushed further out of reach, as Indian companies lose access to low-cost Chinese batteries. Air quality improvements from EV adoption may be delayed, with more polluting cars on the road for longer. Workers in existing Chinese-owned plants face uncertainty as political tensions threaten jobs and future hiring. The economic conflict at the top trickles down, creating anxiety for families and communities. The stakes are personal and immediate. China's move sends shockwaves far beyond India. Southeast Asian countries like Vietnam and Indonesia may seize the chance to attract Chinese investment now blocked from India, intensifying regional competition. Western powers, especially the US and EU, see both risk and opportunity. They may step in to partner with India, but worry about instability between two nuclear neighbors. Global automakers and tech firms could fill the gap left by China, bringing new capital and technology to India's auto sector. But supply chains are at risk, and companies with operations in both countries could be caught in the crossfire. Expect diplomatic efforts to de-escalate tensions as the world seeks stability in the Indo-Pacific. Other nations, wary of China's economic leverage, may accelerate efforts to diversify away from Chinese supply chains. The message is clear. Economic ties with China come with real political risks. Experts agree. India's auto industry faces tough years ahead. Growth in electric vehicles will likely slow, as Indian firms lose access to China's cheap batteries and advanced tech, but many see a silver lining. This crisis could spark a wave of domestic innovation and investment in homegrown EV technology. In the long run, India may emerge with a more resilient, self-reliant auto sector. Globally, the industry is fracturing into regional blocks, China-centric, Western, and potentially India-led. Automakers will need to rethink supply chains and partnerships for a more divided world. Watch for new government incentives, global partnerships, and the fate of Chinese brands still operating in India. The road ahead is uncertain, but transformation is inevitable.